Hello, everyone. Thank you so much for coming. This is a series of events that we at Mint do around the country to talk about global investing. I am from Pune, and some weeks ago I had tweeted that I really wish that Pune becomes the next fintech capital. And Sajid Pai replied to me saying that if there's any city that's likely to be the next fintech capital, the next rival to Bangalore, it's going to be this one. Mainly because of Gift City and what's happening there with global flows, it is highly possible that this becomes India's Singapore, India's Hong Kong, and some of the key players in that space are going to talk to us today. This is my favorite chart about global investing because it tells you the history of the world stock market. You might ask, where is India in all of this? The answer is that India is too small to come onto this map. In the global scene, we are a small cap stock. And when we are 90%, 100% in India, we are all invested entirely into a global small cap. Without any further ado, I'd very much like to invite Mihir from our regulator, from IFSCA, to come and tell us about all of the exciting developments that are happening in Gift City. So we will begin at the very basics in terms of IFSCA karta kya hai, inbound or outbound kya hota hai. So let's just start with a brief about what you guys do.
First and foremost, not many people are aware, I guess, about what IFSCA is all about and what is Gift City is all about. So just to keep it very plain, Gift City is an enclosure within India, but it can be treated as offshore of India. So any entity which is coming and financial services. So everything in Gift City is related to financial services, financial product side of it. So any entity which wants to enter into the services, they can come, they set up their shop. Gift City has been there for a long time, okay. But in 2019, and by an act of a parliament, IFSCA was created. So earlier, the likes of SEBI, RBI, IRDA, and PFRDA were the ones who were looking at this particular zone. And they were looking to frame the regulations and all. But some government felt that it's not moving anywhere. We require a regulator which would be looking at these things, and our competition is really not India, it's abroad, be the likes of other jurisdictions like Singapore, Mauritius, or for that matter, Hong Kong, or Dubai for that matter. And that is how IFSCA came into being. We inherited all the Domestic Regulators Act. What we did after that was we started benchmarking ourselves as to what kind of regulations are there in Singapore. What is making our Indian managers, be it fund, be it banks, or even the aircraft leasing companies, to go to those jurisdictions and do India business. And that is, I guess, it all started with our current PM, at that point of CM, went to Singapore and he saw a lot of Indians working over there and doing India-related business. And that is how he came back and he set up a GIFT. That's a separate story altogether. So that is how we started. So we have a risk-based approach. Somebody who wants to do only, let's say, venture capital kind of a business, they can simply do an authorized entity because the retail investors are not involved. Similarly, somebody who wants to do a retail business, so they can take a retail license which is at the highest pedigree, where a lot of oversight is there by the regulator. And then there is a mid-category where a lot of PE guys are there, but still this is out of the zone of the retail investors. We created an environment or a regulatory framework which is more principle-based, where we regulate the fund manager and he can come out with a strategy. So that is what has gone. So our idea is to provide a platform, in a nutshell, to attract the offshore business which was happening from other financial centers into GIFT, so that India-related business happens, the talent gets developed over here. And to a certain extent, I would say, let's also provide some diversifying opportunity for the resident Indians by having an outbound fund.
Right. So, Mir, I'll focus on the inbound funds first. So, as many of you would know, the vast majority of inbound funds are AIFs. मतलब कि $1.5 lakh minimum investment चाहिए. just to understand how inbound funds function and the big tax benefit there, because my understanding is that an inbound gift fund which feeds into a mutual fund inside India, a domestic mutual fund, is not taxed in India, whether it is in gift or whether it is onshore. There is no taxation whatsoever. And this is a huge, huge benefit.
As you said, yes, inbound funds are there. It all started with the AIF, let me put it that way, where there is a minimum ticket size of 150,000, and which were the earlier days where the private equity and the venture guys came in. And slowly we started seeing a lot of long-only strategies coming in, our own fund managers, like DSP, HDFC, Marcellus and all, they started coming and doing the fund. Today, if somebody is coming from, say, Singapore, they take an FPI which is tagged as Singapore FPI. Similarly, if some fund which is investing in India into the listed equities, it would be tagged as GIFT FPI. So that has been a good number when we see number of FPIs coming in. And what we did, one change during that time in early 2022, during our regulations, we allowed investing in mutual fund, which otherwise an AIF is not allowed to do during that point of time. And that created a lot of doors where people started creating a pooling vehicle in GIFT, where you can pool money and put it into the mutual fund side of it.
I'll just finish off this point by talking about KYC, because you have a consultation paper out there which will enable video KYC by NRIs living abroad or any, I think NRIs from 10 countries.
At this point of time, it's a NRI. So what happens, regulations are in place, you're doing fantastic work, a lot of managers are coming. So now we get into, let's say, phase 2, which is on the operations side of it. And that is when your hand gets dirty, you come to know what are the challenges which are there. So and that is the time we keep taking a lot of feedback, and that is how we have grown. So a lot of managers came to us and said, till the time it was non-retail or accredited investors, it was okay to do the KYC in a normal way, how we do it. Even that is a pain, but still it was bearable. But when you are looking to have a retail setup, then getting one person, individual, to sign a check, or I would say document and send it over here, is going to be a tedious task. So what can you do? And that is the reason we started having a working group. We spoke with government, FIU is part of it because everything is born out of PMLA Act. Trial would be done where any NRI today who is having an Aadhaar and an Indian number which is an OTP, they would be able to do it. So what we are doing, when I say what government is allowing us to do is not to have an IP which is based in India, which today is a norm. So that is something which we are going to start doing it. I think that will also help a lot of people to onboard people in a most seamless manner.
And you whitelisted 10 countries for that purpose?
Yes.
Including the major ones, right? UK, US, UAE.
So normally where we have a large diaspora, that is one which have been selected. I guess even Aadhaar has certain database as to where these people are, where NRIs are having the number. So it was a combination of both.
Now, let's come to the outbound fund. Can you give us some numbers, how many have been approved or applications, etc.?
So, on a non-retail front, the number is in double digits, which goes into it. So, there are certain pure feeder funds which are going. So, they're raising money from Indian citizens and putting it into the Nifty's ETF and all. And there are certain people who are actually doing very good research and investing in those companies in the New York Stock Exchange and all. So this number is in double digit. On the retail front, one is approved, which is the DSP one. I guess there are a couple of more in the pipeline which should be coming in 1 month or two.
Much to look forward to.
Certainly.
And as far as distribution goes, can mutual fund distributors in India distribute inbound and outbound?
So anyone who wants to be a distributor of a fund can actually come register with us and can start distributing the fund. But that does not mean that somebody who is not part of it cannot do it. He can also do it, but he will have to then follow the codes which we have laid down, and that would be implemented through the FME. That is how it works.
Now, on the retail funds, do you have any cap on expense ratio? Do you have any norms that they can't exceed more than 10% in a single company? What are the safeguards for retail?
Right. At this point of time, we have we have not prescribed any cap when it comes to the expense. But what we tell to each and every fund which is getting approved or filed with us is that they have to mention very clearly what is the total cost. This should not be that they just simply say, this is my cost, but I am investing in, let's say, XYZ other fund, and that cost is not shown in the offer document. That should not be the case. It has to come as a total cost which is going to come. And as far as the investor protection has come, I would say SEBI is doing fantastic job when it comes to the mutual fund investor protection side. So we have also today adopted the same limit. So single exposure of 10%, not beyond that. Overall 25% for the sector, and maybe for the financial sector is 50%. In group company, how much you can invest. So all those things are very much put into place.
Now, one other exciting part about GIFT and IFSCA is that we are going to soon see IPOs coming up here. Can you tell us more about that? How do people open Demat accounts?
There is a catch here, let me put it that way. We are not able to get the free hand the way we wanted. So what has happened is that IPOs are going to come. Maybe very soon you will see one of the listings coming up. So if an NRI is there, he can invest in any of the companies which are getting listed on the stock exchange. So that way they can approach to any of the brokers. There are more than, I'd say, 70, 80 brokers which are there in GIFT IFSC, which are trading on board the exchanges. So they would get onboarded with a broker, and then broker would do rest of the things which are required for getting the Demat account and all. So initially, even the IPO which we were expecting to come, the Demat account will take some time because it's the new setup and all. But still they can go through the broker and do it. That is how the process is. For an Indian resident, today that is somehow they cannot directly invest into the company because it's an Indian company. As I said, from a FEMA perspective, it's a foreign company. But from an MCA or for any other act, it's an Indian company. So that is something which today is not allowed for an Indian. But tomorrow if we have, let's say, a company which is based in some other jurisdiction, like let's say some company which is coming from Sri Lanka and getting listed. In that case, an Indian resident can also invest.
So for example, if Tesla tomorrow wants to somehow relocate to GIFT,
right,
Indian residents can buy into
yes,
that?
Very much.
Okay.
So idea is that I'll encourage everyone to have a look at our IFSCA website. It gives a lot of data points as to what is happening. Understand what is being done, because not many people still comprehend what is GIFT IFSC, what it is. It's not a tax heaven, let me put it. We are very much into the substance side of it. There are a couple of notices which have already gone to the entities stating that you require people to be based. And I would say it's a long journey. We have just begun. The growth has been good to begin with in the last 4 years with the number of entities that are registered. But we are just not even touched or we are not even peeled the initial skin.
Sir, how do we prevent another Jane Street happening?
So I would say Jane Street, at this point of time, there are market surveillance and mechanisms which are being done. And the way they traded, the way it was being traded in the exchanges was a strategy, pure strategy, and how it was able to do it. Similarly, we are also working and taking cues from the way the things are done. We have our own mechanism in terms of the cyber security monitoring and also the trade monitoring dealing room which is being done at both the exchanges. So we monitor that for any unusual or I would say fluctuating trade, it does flash into the exchanges dashboard and gets passed on to the regulator for taking the thing. So at this point of time, after that, we have done a thorough audit to see if there is anything which has happened at our end. But luckily, there is no such trade from the Jane Street which was done at our place. That is what I am aware.
What will be the process of accredited investor into the GIFT City?
So there is a guidelines or circular which is already in place, which gives a definition of who is an accredited investor, and also the quantum as to what it requires to fulfill is very much similar to what you find in the domestic side of it. So you can visit IFSCA website, you will be able to catch hold of the circular.
Yeah, if I remember correctly, it's $1 million in assets, right?
500.
Of which 500,000 have to be liquid.
Yes.
Yeah, or an income tax income of $2 lakh US. Mir, thank you so much. It was lovely having you, and it's something I certainly look forward to in terms of what more can happen. You guys are lucky to live here, so close to all of the excitement. So,
Thank you. Pleasure. Thank you for Thanks.
All right. Can I now invite Jay of DSP and Ankita Pionic to join me on the stage, please? Jay, if you want to take us through the construct of your fund, the first retail outbound fund in GIFT City.
Sure. Thanks, and thank you for the opportunity, Neil, and good evening, everyone. And thanks for the opportunity. Lovely to be here in Ahmedabad, and we come to GIFT City more often every 15 days, so it's always a joy coming here. In terms of our construct, the DSP Global Equity Fund, as it's called, so it's the retail fund where the minimum is $5,000 and all incremental assets will be at $500. In terms of our construct, so as I mentioned, it's a retail fund, but in terms of the entire construction, so this is going to be investing across the world, which includes the US market, Europe, Asia, and the other kind of markets, including the Middle East. In terms of a slight difference versus what you generally look at in terms of the global funds, when you look at the global funds and reputed global investment houses which kind of invest in these funds, they usually benchmark their fund to MSCI All Country World. It's called the MSCI ACWI. In our case, we are not going to be benchmarked to MSCI ACWI. We wanted to keep it a very bottoms-up, focused on companies. So currently, our model portfolio suggests that our underweight on US is going to be substantial. So versus an MSCI ACWI with 64% investment in US, we are going to be only 25%, and we are overweight on all other markets. That is Europe and Asia. So Europe will be around 25%, Asia will be 40%, which includes Hong Kong, Taiwan, Korea, Japan. And to the question which was asked that, which are the markets which are looking better, and Ankita can obviously add to that, but Europe and Asia look definitely interesting. Even in US, there are a couple of healthcare IT companies which look good, but generally we are underweight on the overall country. As far as the return expectation is concerned from a global investor standpoint, if you look at the last 10, 15, 20 years, you did notice that, give or take, you made around 9 to 10% dollar return at any given point in time. So incrementally, what we're going to be focusing on is just kind of look at companies globally which can give you 11, 12% gross returns, which is a combination of the earnings growth, which is 6, 7%, and then you look out for shareholder yield of around 4%, 3, 4%. So that gives you around 11, 12%. And our aim is to look out for companies, again, easier said than done, but we look out for companies which are trading at maybe 20, 30% discount to its fair value, which gives you that upside. So net, you're trying to look at companies across, whether it's internet, and more importantly, this strategy is a great diversifier. And thanks for bringing this topic up in terms of the global allocations, because a couple of points I want to kind of also leave everyone with is that while when you're investing globally does not mean you're bearish on India. So that's point number one. Second is that over the last 10 years, India was the best performing market only 2 times out of the 10 times, which tells you that other markets also have an opportunity. Number 3, if you look at the Indian market cap, which is close to $5 trillion, and when you look at the global market cap, so you're just 4% of the global market cap, so you have another 95% to invest into. And the correlations of India versus globe is extremely low at, maybe 30, 40, 50%. So it gives you a complementing strategy. So net, we want to invest across the world. We want to invest in good companies. And also, let me address one question is that when Indian companies or Indians kind of invest globally, a question would be asked that why are you going global? Do you have the expertise? I will just flip the question that even maximum of investors, even in the US, are now kind of looking at shifting their active allocations to passive, because even there the alpha generation is not happening. So the idea is the first principle, stick to your basics. You hide the company's name, try to invest into those wherever they are, whether it's in India, Europe, Asia, Middle East, US, and try to stick to the first principles, you'll end up making money. So that's the fund for you, and it's now kind of open for investors.
$5,000
is the minimum.
Okay, if you can just elaborate on 2 things.
Sure.
One is number of companies you will hold in
Sure.
the fund,
Yeah.
and the big one, which is tax.
in terms of the number of companies, so our general criteria had been around $30 billion cutoff. Again, just to kind of have the method to the madness in terms of when there are globally 3,000 companies to choose from, we wanted to kind of make it more kind of relevant. So we just thought that, $30 billion is a good market cap to kind of look at. Not that we are not going to have companies which are lower than $30 billion. So we get a universe of around 300 to 400 companies. Of that, then we do our analysis in terms of earnings growth, valuations, quality of earnings, quality of growth, etc., etc. That we get around, we want to have a 25 to 30 stock portfolio at any given point in time. So that's going to be our focus. And as far as taxation is concerned, and indirectly, I think somebody had asked about the taxation, how it's going to be subjected for investors. So unlike the mutual funds where you pay tax at your level, so if you redeem more than 1 year, it's kind of long term. If you redeem lesser than 1 year, then it's short term. Here, it's at the fund level. So at your level, you don't land up paying any taxes. At the fund level, it is short term capital gains tax is 42%, but for 2 years. You have to hold stocks for 2 years, and that is onto the fund manager to kind of have a control on that. And after 2 years, it becomes 15%. So that's the kind of breakup of the taxation. And therefore, we have also had an exit load of up to 2 years. We've not kept any lock-ins just to give that flexibility to our so-called retail investments, if you're calling it retail. So we want to give that flexibility. And at our level, we'll try to kind of manage that. So 42% short-term, 15% long-term is the taxation.
Ankita, can you tell us first about Ionic and then the fund?
Ionic AMC is a part of the Ionic Wealth and Asset business. It is backed by Angel One, which is, one of the bigger listed brokers as we know it today. So that's a 15-month-old entity as we speak. But I think we've done reasonably well both on the wealth side and on the asset side. We are present in about 10 cities now. We have an employee strength of about 200. And more importantly, we've been able to garner an AUM of about 5,500 crores in a very short span of time, because of those 15 months, a chunk of our time went into getting the right licenses and regulations into place. So that's Ionic AMC. A very, very experienced team. We do very selected products, and I think global investing is something that appealed to us naturally. Of course, we were starting afresh. So, doing something where there is legs and we can build it, that expertise naturally appealed to us. On the fund, unlike what Jay spoke about, which is a retail license and which is, India's first retail license that DSP actually holds, ours is a non-retail license, okay? So think of it, if I were to give you a domestic example, think of it as a difference between a mutual fund and AIF, right? So mutual fund, anyone can come in, the ticket size is small, rules of SEBI kind of apply, whereas alternates manager tend to enjoy a little more flexibility per se, at the same time being responsible. So we hold AIF license in GIFT. The difference between the two licenses is that, DSP can, a retail license rather, can have a very small starting ticket size. For us, because it's an AIF license, the starting ticket size is $150,000. But if you're an accredited investor, that ticket size falls to $10,000. So we are also actively passionate about, slightly democratizing this space and allowing more people to actually participate in the outbound story. And I think it's a great diversification. India today has reached a point where everyone thinks equity is a decent asset class and can sleep with the volatility. India of 2000 thought maybe equity is gambling. So we've come a long way from where we started. Now, next step, I am quite sure, will be to look offshore, like was a journey for US. Onto the fund, it's called the Global Innovation Fund. So as Jay said, I think we also have this hypothesis that taking all your money out of India for diversification and then putting it in US, which is you basically saying don't put your eggs in one basket and put it in another basket, or divide your eggs in just two baskets, which is not something we resonate with. And in terms of what is deployed as we speak today is 50 US,
30 East Asia, which is China, Korea, and Taiwan. 15 is Europe, and 5 is Latin America. Now, this is not hard and fast for us, of course. If, tomorrow, for some reason, US hits a recession and, Fed says another QE and rate cut, I'll be more than happy to add stocks at a cheaper valuation. On the contrary, inflation never stops going up in US because Trump is crazy with what he's doing with tariffs. I'm happy to bring down US to even 20% or lower. So this is active call on the geography, which is embedded in the strategy itself.
Ankita, can you talk a little bit about which stocks you hold, how many
Sure.
stocks?
Sure. So I think a bulk of our focus is on innovation enablers per se. So we hold companies like Arista Networks, which is into data center ke switches and circuits banate hain. But also like a TSMC, which is very, very popular, but because we also still like it. In the very popular Max 7 space, we hold maybe 2 of them, not anything else. We've never touched a Tesla in our life. We in fact like BYD more than we like Tesla, because Tesla, what you're getting for 100 times forward PE, BYD you're getting it for 15 times forward PE. Tesla has no sales volume growth. BYD is growing not just in China, but also in Europe. Tesla batteries comes from China, and therefore every time Mr. Trump makes an announcement, it's a problem for them. BYD makes its own battery and also sells it to other people, including, your Mercedes, BM, Toyota, Tata now. And it's a 25% margin business. So we haven't touched Tesla ever, and we hold, 4.5% in BYD. But the flavor of stocks that we have could be anything that's innovating, could be in any sector, but we need solid financials, and we prefer enablers over the front-end names per se.
So which of the Max 7 and total how many stocks do you have in the portfolio?
The PPM says 20 to 35 stocks. Right now, we are invested in about 30, so that 5-stock space is between us. In the Max 7, now that we are taking names, we only own 2 stocks. One is Microsoft, the other is Meta.
Okay, I'm going to finish off with the tax question.
Sure. For our fund, the master fund is offshore, which essentially means that when we churn the portfolio, there is no taxation on the fund NAV. And thereffor, taxation is at the redemption for an investor, which, like any other offshore fund, becomes, I think, 14 after 12.5 plus cess, etc. So 14 after 2 years, and remains the marginal maximum rate, MMR, which is closer to 42.5% before that. But churning, there is that advantage of us holding a offshore master fund that's there.
As an humble small investor, I don't care like where you invest. What I care about is the return, the black box kind of thing, right? So that's number one. Number two is 33% of the portfolio investment overall I'm talking about, compared to like 66% in real estate, 33% in mutual fund. Is it good strategy? Or I should increase? And second question is when to exit.
Sure, I'll just probably give it a try. So basically, see, here there is no right answer because, based on your kind of temperament and your life goals, this answer will change. Second is the classic answer which you'll generally get is ask your advisor what's the best for you because he or she understands your needs the best. The fourth is that just in terms of, whether it's 33% in equities and 65% real estate, it may be completely opposite for somebody else sitting in this room where they're 95% invested in equities and 5% in just cash just for emergency. So that will keep on changing. But I can only just mention one thing is that time horizons are also based on when you need the money. So when you need the money, you need the money. So in terms of then your horizon changes. The more you spend time, it will compound, and the power of compounding for many number of years will give you those outcomes. So I think it's more situational. So there's no right answer. So at least from my point of view, there's no right answer, but please,
I think I just want to elaborate on one point that Jay raised, which was that when you do your outbound investments, especially using your LRS pool, think of it also from the planning angle beyond pure return angles, and let me tell you why. So when we've been speaking to our clients, extremely well off in the Indian context, but now the son does not want to come back to India, wants to set up a company in Dubai. Indian laws restrict you to the 250,000 LRS per PAN card every year, right? So you can't fund that company overnight, which essentially means that if you had built that pool over years, and let me tell you, most sophisticated investors have, they can use it for whatever reason they need to be abroad, be it second generation, be it property purchase, be it medical emergency, the unknown part of it, right? So I think that aspect is the planning aspect, and then there is a return aspect. On the return aspect, again, that's not a commitment that we make. I mean, equity will always be subjected to market volatility. But historically, if you held 100% India versus if you held 50% India and 50% global over a 10-year horizon, your CAGR tends to go up by 3%. So there is that takeaway that you should work with. And obviously, if that INR depreciation happens at whatever pace, not within our control, it's how the economy decides to work, that becomes like the cherry on the cake, albeit cake is what Jay and I will work for very, very hard in terms of growing the investments.
We are talking of getting investment from FIIs, one side, right? The second side, we are talking of outbound investments.
Yes.
Okay. लाना भी है
और
भेजना भी है राइट तो मतलब क्या अपना एक एम है फोकस है राइट दैट इज फर्स्ट थिंग सो क्वेश्चन ये है कि हम आउटसाइड टेक्नोलॉजी में इन्वेस्ट करना चाहते भी हैं राइट और दूसरी बात यह भी है कि हमारे स्टार्टअप जो जैसे चाइना ने किया वैसा इंडिया में भी गूगल को रिप्लेस करना चाहते हैं और काम चालू हो गया है और हो भी सकता है राइट तो हम जब बाहर करेंगे और हमारा अपना ही खुद रेडी हो जाएगा तो क्या हो सकता है आई वॉन्ट जस्ट कमेंट फ्रॉम यू सर थैंक यू
Sure. No, that's a great question. So, great question. So, answer is it's not either or, it's both. So, I'll just give you a quick perspective. So, and a few numbers which we all should understand. Currently, FPIs और जो foreign investors बोलते हैं वो almost 970 billion dollar का उनका investment इधर है या almost 20% of the Indian market cap. DIIs जो domestic institutions का होता है उन लोग का भी अभी 19% हो गया है, which includes the mutual funds, insurance companies. So the idea is that this ecosystem, which through the IFSCA gift platform, we want to kind of get global capital in. That is, go outside and tell investors to invest into through our so-called the entire financial hub. जो आज so far we used to go to Singapore or DIFC या कहाँ और this is a dream which India dreamt of and the government dreamt of, that why don't we have our own ecosystem, which is itself a big thing, and we are just trying to kind of contribute to that. Number two, as far as investing outside is concerned और आपका जो entrepreneurship का बात है वो absolutely valid है और वो जो पैसा अंदर आएगा over the next few years. So this year we've already lost $11 billion. कितना? $11 billion बाहर चले गया है. So which can make you think कि ये लोग कभी आएंगे या नहीं आएंगे. We are pretty confident that I won't be surprised that you're talking about $100 trillion of global market cap. वो 1% भी करेंगे. So it's like a massive inflow which can come into India at some point in time. So can $25-30 billion per year come into India over the next 5-10 years? Definitely it can. और हमारे entrepreneurs को जो startup ecosystem है उनको भी पैसा मिलेगा. आज हम चाइना या हांगकांग या दूसरे देशों की बात करते हैं इंक्लूडिंग यूएस, उनको पैसा इसलिए मिल रहा है बिकॉज दे हैव स्पेंट ऑन इनोवेशन. अब वो लोग 7-8-20% ऑफ देयर रेवेन्यू दे स्पेंड ऑन इनोवेशन, हम लोग आधा टका भी इन्वेस्ट नहीं करते हैं. दैट्स व्हाई वी हैव नॉट बीन एबल टू इनोवेट बियॉन्ड अ पॉइंट, बट never say never, there will be a time. So this platform you have to look at, it's encouraging both.
German markets, Hong Kong, Japan markets, all these markets are up 30% in very shorter time frame. So how valuations look from this point in these markets?
From our point of view, we are going to be investing across the markets, and see, valuations is also relative, right? So even when you spoke about the US market, the focus was on the top 7, top 10 companies which are kind of leading. Likewise, even in India, it's like polarized, right? So there are pockets of opportunities which are there. There are pockets of sector stocks which you want to avoid. But as far as Europe is concerned, there is consumer discretionary, there is a few of the autos. So there is opportunity across markets. So our job is to find those value across. So from our allocation standpoint, within Europe, it's going to be a mix of Germany, France, Italy, and Sweden. So these are the 4 kind of geographies where we are going to be focusing on. And there are brands which are there, consumer discretionary companies which are there, which you can take exposure to. So you just have to find your comfort. And just recall my first point, which I mentioned, is that we are looking out for 50-60% upside in a stock over the next 3 to 5 years, which tells you that 11-12% CAGR return expectations. So every stock which comes into the portfolio will be ticking that box. So we're not going to be forced to invest. So abhi filal, if there is a 10%, 11% cash, we are fine with it. Right? And therefore, we will allocate. So answer to your question is yes, we will look at the European markets, but of course, we look at companies and not be forced to invest into each and every opportunity which comes by.
Sure, and since this question was also raised before, ki undervalued markets generally kaun se hain? So basically, there was China at one point, though it has run up now, but I think Korea is also trading at about some 12 times forward PE.
It's a bit hard to digest. India is north of 20,
yes,
and Korea is 12.
And let me tell you, just add to it. So we've had this short dollar weakness cycle, right? We saw a dollar go from 110 to 96. Now, the case was that when that happens, EMs tend to benefit. So FII money should come to India. And Jay mentioned the amount that we've actually seen an outflow in this short time. Why did that happen? Is because FIIs are also looking for valuation comfort. They are coming out of a market, which is US, which is overvalued, and at about 24 times forward PE adjusted on NASDAQ basis, and then coming to India, which is also overvalued, doesn't make sense, right? So they became very valuation-hugging entities, and then they went to in bulk to Korea, Japan, Latin America. We talked about the Brazil fund not doing well since inception, but YTD, LATAM index is up about 13%.
I want to know something about the estate duty that would be applicable on your investors. I believe that your fund would be domiciled outside of US.
The estate tax which you're talking about, the US related, that is more applicable on the stocks, not the funds. At least, our fund will not kind of attract that. So that's very clear from our point of view.
Ankita, Jay, thank you so much.
Thank you.
You guys are doing some pioneering work in this space.
Well, likewise you are. So thank you so much.
Neil. Yeah, big round for Neil. Thank you.
I will quickly introduce the last speaker of this evening. And this relates to one of the questions that was asked about transaction costs. So we have a host of platforms now, a host of fintechs in India that have made this pipeline smooth of investing abroad, of getting back the money, dealing with all of the paperwork, dealing with transaction costs, and Appreciate is one of them. So let me now invite Shubho from Appreciate to take you through that pipeline and about how you can invest abroad. Shubho.
Hey, thanks, Neil. Hello, everyone. I'll be talking a little bit about how you can be your own fund manager, because this is the age of DIY, and there's a lot of power you have in your own hands, right? So while there's definitely a thesis on emerging markets and markets outside the US, the fact is that in the last 10 years or so, possibly 15, the US has outperformed every market. And if you look at sort of what we're looking at, while if you had invested in NASDAQ 100, 5 lakhs become roughly 13 lakhs, whereas you would see 11 lakhs, 2 lakhs, that's a lot of money for most people. Yeah. If you now also think about, and this is the point that I think Ankita made, India is only 4% of the world's overall market cap. There's a lot more depth in the US. And today, versus earlier, you have a lot more information. There are strategies you can use to figure out what works for you and how you can build your own portfolio without complicating anyone's life, right? Bull markets tend to be fairly long. On average, 5 to 6 years. I think the last 15 years have been fairly exceptional. There's been a dip right before this. I think we're 3 years into what I think is probably a 4 to 5 year bull market, right? So ultimately, the other thing is that if you really wanted to invest, I think you could have invested in a domestic mutual fund, but there's a 7 billion cap. You can absolutely invest in funds like Jay's and Ankita's. Those are, good methods. But you can also increasingly invest on your own, right? The other thing that you see is that the expense ratios you see right? When you pick domestic mutual funds or indeed actively managed funds, are very large. So there's always a trade-off, right? If you believe that the actively managed fund gives you significant outperformance through active management, then you can pay the expense ratios. If you believe that you want to pay much lower ratios, plenty of opportunity there. Now, where do we come in? We were founded roughly, I'd say, 5 years ago with the thesis that there is increasing value for people like you to invest abroad, right? And typically, there were 4 barriers that prevented the average Indian investor from investing abroad. Barrier 1 was lack of awareness. Increasingly, that's disappearing. Everyone's aware. Everyone now understands it's a good thing to do. Second was lack of access. I think Jay was talking about I have to fill out a physical A2 form, speak to my RM. Will the bank charge me a terrible rate? Will the money reach? What do I do about tax? We've removed all these barriers. So if you were to download the Appreciate app, you can onboard in roughly 3 minutes, and you can complete a transaction in roughly 15 seconds. Fully digital, end-to-end. We've also reduced costs significantly. So I think some people asking, what's the cost, right? We typically make sure that the percentages charged stay at or below 1% in terms of forex rates, and your actual transaction charges are typically single-digit rupees, right? So if you look at FEMA compliance, if you look at all other kinds of compliance, fully compliant, so you can invest without worrying about, am I breaking a law? Yeah?
All right, everyone. Thank you so much for coming today. Look forward to this space developing a lot further.